Vertical spreads are the action of buying and selling put or call options at the same time. We do this because it provides a totally different risk-reward ratios and different win rates. In this video, we're going to talk about spreads using call options. There are two strategies we can apply, and that's the bear call and the bull call. As the name suggests, the bear call, it's a bearish strategy, and the bull call, it's a bullish strategy. We're going to do the same thing as the previous video. I'm going to consider myself, I don't know anything about the strategies. So we're going to figure out together how they work. So we're going to do a bear call on Moderna. So as the name suggests, the bear call, it's a bearish strategy. But if you buy a call option, you can only make money when the price of the underlying asset goes up. So between the two options that we're going to buy and sell in this vertical spread, the one that we're selling should have a bigger net premium. This is what I mean. I'm going to click strategy builder on, and let's start building a strategy. The current price of Moderna, it's around $260. First thing that I'm going to do, I'm going to sell one option at 275. If you check delta of this option, it's 0.3. That means if the stock goes up by $1, this option will go up by 0.36. So as we said, this is a bearish strategy. We can see from the chart, if the stock stays below 275, we're going to collect the full $790 premium. But your maximum loss, it's theoretically infinite because the underlying asset can go up infinitely. So this is where the spreads are going to help us a lot. If we're going to buy another option, we should buy something which is less than 7.9 so that the net premium will be negative. That means we're selling call options. It's the same effect of selling an option. So we're going to choose any strike above 275. That means we're going more out of the money. Let's choose, for example, the $300 strike. The first thing that you're going to realize is that delta is negative, and interactive brokers directly realize that this is a bear call. If delta is negative, that means you make money when the stock price goes down. And if we check the performance profile of the strategy, we're going to realize it's very close to the bear put. Your maximum profit potential is limited, your maximum loss is limited, and you have one break-even point. If we check, your maximum profit potential will happen, which is at 460, if the stock goes below $275 at expiry. And 275 is the option that we sold. So your maximum profit potential will be the difference between the net premiums, which is minus 7.9 because we're selling this option, plus 3.3, and the net premium is minus $4.6. So this is acting like we're selling a call option. And if we're selling a call option, your maximum profit potential is the amount that you're going to collect. It's the same thing here, which is $460. And your maximum loss will happen when the stock goes above $300. And the loss is $2,000. How? That will be the difference between the strike prices, which is 300 and 275. 300 minus 275, it's $2,500. But at the same time, you're collecting the $460, so minus 460, and that will be $2,040, and that your maximum loss. The more you go out of the money on this bear call, you'll have a much higher win rate. For example, in this case, we're out of the money because the current price is around 260. This bear call have a 70% win rate, and my risk reward ratio is around 1/5. If we do another bear call, we go more out of the money. We can sell the $300 strike and we can buy back the 340 strike. If we check the performance profile of the strategy, you have 90% chance to win. Your break-even point will be 302. This is the chart of Moderna. Using this bear call, we're betting that on December 3, Moderna will stay below $300. And if it stays below 300, you're going to collect the full $210 premium. And for that to happen, you have 86% chance. However, your maximum loss will happen when Moderna goes above $340 in the next 10 days. If we check the chart of Moderna in the next 10 days, this is where 340 is. So based on that performance profile, it's saying that there's only 1% chance for that to happen. And if that happens in the next 10 days, your maximum loss will be $3,700. And now the more you go in the money, you're going to have a lower chance to win, but a much higher risk reward ratio. If we sell the 220 call option and buy the 240 call, this will be the new performance profile. It's saying that our break-even point is $235. Moderna should drop below $235 in the next 10 days to be profitable. Since the current price is above your break-even, your risk-reward ratio will be much better. If you're going to lose, you're just going to lose $510, and if it goes below that, your maximum profit potential is $1,500. So this is how a bear call works. Now we're going to do a bull call. In the bull call, you should buy a call option because it's a bullish strategy. And if you're just going to use call options, you should definitely buy a call option. So the first leg will be buying a call option. Let's choose in the money call option. 230 call, we bought this contract. Now we all know when we buy a call contract, your maximum profit potential is infinite and your maximum loss is the amount of premium you paid for. In this case, your maximum loss is $3,700. Some people may think that that's a lot of money. I don't want to risk that much. So in this case, you can do a bull call. You can reduce the net premium that you're paying by selling another call option which is more out of the money because the premium will be lower. Let's sell the 250 call option and the net premium will be $1,800. Same thing like other spreads. Your maximum loss is limited, your maximum profit is limited, and you have one break-even point. Your maximum loss will happen when both contracts goes below $230, and your maximum profit will happen when both stocks goes above $250. And the same thing as any other spreads, you have your profit probability and risk reward ratios. If you want to learn more, you should just go to Interactive Brokers and start building up strategies. Check what happens if I go in the money, what happens if I go out of the money. You check the delta, you check thetas, you check if time will work your way. So just play around, check the performance profiles, and you're going to get better. Start with paper trading. After few trades, you're going to fully understand everything. And if you have any question, you can join our chat room. I'll answer you directly.